I just don't see where the bad news is coming from. I mean, this week we had the highest consumer confidence number in 18 years. We've had incredibly strong earnings growth. We're only trading at 17 times 2018, which is basically a trailing multiple at this point.
What about the idea of these cross currents, potentially things going wrong with trade? Obviously, it looks better than it has in a while. It looks like we could be on the cusp of a NAFTA deal, but it's not done yet. And that may be one of the headlines that's kind of hanging out there that people are still concerned with.
Well, I think the manifestation in emerging markets is to be expected, and a lot of that's from quantitative tightening. I mean, we just heard whispers of the BOJ starting to even more rein in their bond purchasing. In the first half of 2017, we had $1 trillion of bonds bought by central banks. We only had 100 million the first half of 2018, and we know that's going to put pain in emerging markets.
Yeah.
So when you look at the marketplace, when I go back 5 years, when you go back a year, 3 years, 5 years, it's always the same top performers. You always get tech there. You always get consumer discretionary. You always get certain players. Do you think that's going to be the same going forward?
Well, the difference this time is there's a little more stability on that side for two reasons. Number one, there's real earnings, of course, on the tech side. Earnings growth in technology has actually eclipsed the S&P 500. That's a lot different than the last time we had a tech rally. The other thing is the tax change. You know, the corporate tax cut is most meaningful for companies that have pricing power, because if you don't have pricing power, then those tax cuts go right to the consumer. So it's a lot of the tech names that have the ability to keep their prices where they are, even in the face of the tax cuts. That said, they're a little expensive. Not as expensive as they look on a sort of a classic price-to-book basis, but still a little expensive. And maybe a rotation more towards the center of the style box makes a little bit of sense.
All right, let me throw one more at you. You do have all this headline risk for the potential for regulatory interference or anything that comes from a tweet these days. If you're Google, if you're Twitter, if you're Amazon, we just talked about how they've been in the crosshairs of the president. And some of those companies are coming next week before Congress to sit down where they really dig in. You've got the right and the left coming after some of these companies, specifically Google, Twitter, Facebook. I mean, they're concerned about interference from the elections. They're concerned about not all voices being heard. Is there a chance that this would be the one bipartisan issue that you would actually see in Washington?
I don't think you need any more reasons to lighten up on technology. If that's another one that, you know, sort of is a catalyst for rebalancing portfolios. I mean, it's been a very strong run. This is it's a wild card. It could happen, but valuation in and of itself is reason enough from my perspective to lighten up a little bit on technology.
Steve, what do you think about some of those names?
Well, when you look at tech growing at 25%, you know, I get you. There's a lot of depth through what you call tech, but tech is a different tech than we saw during the last cycle. Amazon is tech. Amazon is retail. Amazon is cloud. So, and that's a valuation that people can't get their head around. Then you go to an Alibaba, which is the Chinese Amazon, and you can get your head around valuation, but you have your problem with trade.
Right.
So I think you have to stay sort of diversified amongst the tech space, but at 25% growth rate, I think you have to be there. Unfortunately, I don't think you can rotate out of it.
I mean, I even think about that with Apple. If you get caught in a massive trade war with China that extends over a long period of time, Apple could pop up as one of the names where they kind of punish. It's already come up.
Sure, you have two people buying Apple, though. You have Warren Buffett and you have Apple themselves. And Apple can buy more Apple than anyone else for the appetite for the buyback. So there are always buyers on dips, and it seems as though we're all talking about Apple, the $1 trillion mark at 207.04, and we've forgotten that right now. Now we're going to the next stage. Now there's $240 price targets on Apple.